Thursday, November 19th, 2020, Maneco 64, home of alternative economics and contrarian views. Today we're going to look at how the world is drowning in debt, and especially the United States. And I'm not having a go at the United States because every other country as well is doing it, but the US is doing it more than others. US total debt is above 400% of GDP now, and I'm going to go through that number historically and also the forecasts that the US debt clock has for it. And that's not government debt, that's total debt, that's federal, local debt, state debt, corporate debt, personal debt, and of course it doesn't count all the unfunded liabilities either. It doesn't count the missing 20 plus trillion that Catherine Austin Fitts and Dr. Mark Skidmore talk about. This is just official data. So we're going to go through an article that came out in the FT yesterday, and it's entitled, "The Pandemic Fuels Global Debt Tsunami." Well, maybe a little bit, but this debt tsunami has been growing since the 1980s, and you'll see what I mean when I go through the numbers. The interesting thing about this article is that it focused on emerging markets, the whole article. It says here, governments and companies took on 15 trillion more borrowing in the first 9 months of 2020, says IIF. What's the IIF? Well, it's the Institute of International Finance. It's based in Washington, D.C. I try to get their data directly, but you have to pay for it, so I just stuck to the FT. But interestingly, the chairman of this institution is a guy called Axel Weber. He's a German guy. He was the head of the German central bank, the Bundesbank, for many years. Now he's the chairman of UBS. So that's the kind of people that keep track of these numbers, just to let you know. But yeah, interestingly, this article focuses a lot on the emerging markets. It says here, the total level of global indebtedness has increased by 15 trillion this year, leaving it on track to exceed 277 trillion in 2020, said the IFF, which represents financial institutions. It expects total debt to reach 365% of global gross domestic product by the end of the year, surging from 320% at the end of 2019. So this is the interesting part here from a guy from JP Morgan. He comments in the article, he says, and it says, Louise Oganes, head of emerging market research at JP Morgan, said emerging economies ran the risk of rising inflation if they sought to monetize debt by buying their own bonds, as some have done this year, or of deflation if they allowed debts to rise too far. High debt levels will lead to zombie banks and zombie companies that constrain growth, he said. And he just focused on emerging markets, right? But towards the end of the article, they talk about the developed economies, or the wealthy Western economies, so to speak. And they say debts in advanced economies rose by more than 50 percentage points this year to hit 432% of GDP by the end of September. The US accounted for nearly half of this. Its debts are set to reach 8 trillion this year from 71 trillion at the end of 2019. Well, I think it's a lot higher according to the US debt clock. But notice how the guy from JP Morgan said, if emerging market country central banks print money to monetize that, they will have inflation. But for the ECB, the Fed, BOE, BOJ, for them to print money and monetize that, like they've been doing for many years, oh, it won't cause inflation. So what's the difference, right? So that's what I wanted to touch upon, the fact that this article focused so much on emerging markets. But at the end of the article, it admits that developed countries' debt to GDP is almost 500%. It's at 432% of GDP, and I think it's going to go a lot higher than that, to be honest. So what are the developed countries? Well, developed countries are basically US, Canada, most of Western Europe, Australia, New Zealand, and Japan. Everything else is not included there. Not China, not Russia, nor any other South American countries or anything like that. So after having read this article, I thought I'd look in the US debt clock to get the data from there. And they do have total debt for the US. So right now, total debt to GDP is 401.7% for the US. So how does that compare going back? Because in the US Debt Clock website, you can go back to 1980. So let's go back gradually. 2016, it was at 355% of GDP, the total debt. 2012, it was 366%. 2008, it was 358%. So actually, under President Obama, the national debt, or the total debt, sorry, to GDP actually dropped by 3 percentage points. Am I having a go at any president? No, I'm just saying that's the fact. That's the number. So we've had the greatest economy, so to speak, but it's been at the expense of indebting the country even more. So the analogy would be if you saw one of your neighbors buying all these beautiful cars, getting a new kitchen, getting garden landscape, getting a new swimming pool, and then you find out that the head of the household is actually taking on a huge mortgage to do that, and that his or her job is under threat. So just wanted to put that out there. So what about in 2004? Well, that was 322% of GDP. 2000, it was 271%. So actually, under George Bush the younger, the national debt, or the total debt, I'm sorry, total debt went up from 271% to 358%. So that was under a Republican president. So for those people who think that a Democrat administration would be disastrous for the debt, we might need to think again. And I'm not pro-Biden at all. And I don't think the election has been resolved for that matter. But let's continue. Well, from 2000, it skips back to 1990. So back then, total debt to GDP was 255%. And then from 1990, we go back to 1980, and that was 179% of GDP. And the other interesting thing about the US debt clock, on their app, they go as far forward as 2028. On the website, they only go as far as 2024. 2024, they're forecasting 527% debt to GDP. I mean, if this doesn't worry you, I don't know what will. And by 2028, if we can get there with all this debt, if things don't implode before that, they're forecasting 683% debt to GDP. So there you go. I had to look back even further at Weimar, Germany. There's a article here from 2012. It says, so do we really have to worry about hyperinflation? And they say here, what caused the hyperinflation? It didn't start with money printing. It started with the huge costs of the bills of war reparations from World War I. This caused the Republic's national debt to move to around 250% of GDP. That's the national debt. That's just the government debt. They don't include the total debt of the country. But I would say now the Federal Reserve, they're not even just helping monetize government debt, treasuries, but they're also helping monetize agency debt, and they're starting also to interfere in corporate debt. So I would say this is not looking great, not only for the US, but for the whole world. The whole world is drowning in debt. So that's what I wanted to talk about. Yes, precious metals have been frustrating. The consolidation has lasted a long time. Right now, we're trading even lower overnight, but I wouldn't worry about it. Do you really want to give up on your monetary insurance when the debt is ballooning as it is? I mean, even the FT is using the word tsunami, debt tsunami, and it's not me. And I don't think Jay Powell is anything special. I don't think just because he's chairman of the Federal Reserve, he can get away with printing trillions and trillions and not create a crisis of confidence in the currency, because that's basically what hyperinflation is. For all those out there who think there's deflation, wake up and smell the debt. That's inflation. And just wanted to show you an article that's come out, I think yesterday, in The Guardian, just to show you how people have been tricked into thinking the wrong way about inflation. So there's this headline here, and one of my viewers sent me this article, and I thank him for that. And it says, UK inflation rises on back of increases in clothing and second-hand car prices. So this is completely wrong, the way they wrote this headline. It should read, prices of second-hand cars and clothing increase on the back of inflation. Rising second-hand car prices and rising clothing prices don't cause inflation. They're the consequence of inflation. People need to understand that inflation is purely a monetary phenomenon. So when the government and the central bank increase money creation, debt creation, like they're doing, like the FT has told us. FT, uber globalist publication, very mainstream. They're saying we have a tsunami. So even if the FT is warning about a tsunami, even if the JP Morgan guy is warning that a debt tsunami can cause inflation, of course he says only for emerging markets, but he will be proven wrong. It's going to be everywhere. So there you go, 401% debt, total debt to GDP in the US, and that's not counting all the unfunded liabilities and everything else, right? So with that, let's quickly see where the markets are. It's 8:30 a.m. London, so we got spot gold at 1860. It's down about $12. The high has been 1879, the low 1857. Silver, not surprisingly, has been hit hard as well. We're just below 24. The low's been 23.90. The high's been 24.40. I'm not getting rid of my precious metals, no way, especially with the debt tsunami that's coming. So the analogy for probably what's happening to gold and silver right now, to do with tsunami, some of you probably have seen this, the 2004 Indian Ocean earthquake and tsunami. There's a documentary about it. You see on the beachfront by this hotel, I think, the tide went out massively. No one's had ever seen the tide go out so much. Older people, or some other people, knew that that wasn't a good sign. That was the ocean being sucked out before the tsunami came. A lot of people, of course, who didn't know what was happening, stayed there and got completely buried or drowned by this tsunami. So what I'm trying to say, yes, gold and silver are retreating right now a little bit, but I think it's just like the tsunami, right? People are asking, how come gold and silver are not going up? We're seeing more and more debt, more money printing. it should be up. Well, it will be up. You just need to be patient and don't make the same mistake those people did to stay there. And the mistake here would be to get rid of your precious metals and get back into paper. So there you go. What about the stock markets? Well, didn't have a very good day yesterday, the stock markets. Right now, the Dow is basically unchanged, the Dow future, so no change here. S&P 500 is unchanged as well, 35.65. The NASDAQ 100 future is down 0.2%. The currencies, they're dropping back a little bit. Sterling is down 0.4%, 132.14. The euro is down 0.2 at 118.30, and the dollar is up slightly versus the yen at 103.93. Dollar is up 0.25% versus the Chinese yuan at 657.80. WTI crude is down 0.5% at 41.80. And to finish off, the 10-year yield is down 2.7 basis points at 0.86. So there you go. If you enjoyed this video, make sure you hit the like button. Please share it far and wide. Think about subscribing to the channel if you haven't yet. And you can also follow me on Twitter, Parler, Facebook, and all these other platforms below here. I wish you all a great day. Take care. Bye.